These are the financial thresholds that separate financial stress from financial freedom. And your bank absolutely hates when you cross them. At $20,000 in savings, your relationship with money fundamentally changes. But here is what matters more. Your bank's ability to profit from your financial vulnerability completely disappears. Right now, 37% of Americans cannot cover a $400 emergency expense. Nearly 1 in 4 Americans have no emergency savings whatsoever. Only 48% of adults could handle a $2,000 emergency using savings alone. These are not just numbers on a spreadsheet. They represent a massive revenue stream for banks that depends entirely on keeping you vulnerable. Here is what is really happening behind the scenes. Banks collected nearly $5 billion in overdraft fees in 2024 alone. JPMorgan Chase made over $1 billion just from overdraft revenue. Wells Fargo pulled in another $1 billion. But here's the kicker. Only 9% of bank customers pay 79% of all overdraft fees. These are people carrying balances under $350, overdrafting more than 10 times per year. Your bank's business model relies on a simple equation. The less money you have, the more money they make from you. When you are living paycheck to paycheck, scrambling to cover basic expenses, you become what the banking industry calls a FEE-generating customer. Every overdraft, every insufficient funds charge, every monthly maintenance fee adds up to serious profit margins for them. But something magical happens when you hit that $20,000 threshold. Research shows that people with even $2,000 in emergency savings report a 21% increase in financial well-being. Having 3 to 6 months of expenses saved adds another 13% boost. The psychological impact is profound, and you stop making desperate financial decisions driven by immediate need. At $20,000, you virtually eliminate overdraft fees. You qualify for premium account benefits that waive most banking charges. You stop paying for expensive financial services that prey on cash-strapped customers. Essentially, you graduate from being a profit center to being a cost center for your bank. The Consumer Financial Protection Bureau recently tried to cap overdraft fees at $5 for large banks. The industry fought back hard, arguing that limiting these fees would somehow hurt consumers by reducing access to banking services. In February 2025, Congress voted to repeal the rule entirely. The banking lobby claimed that without overdraft revenue, they could not afford to offer free checking accounts to low-income customers. This argument falls apart under scrutiny. Capital One eliminated overdraft fees entirely in 2022. Their overdraft revenue dropped from $57.9 million in 2021 to just $123,000 by 2025. Did they stop serving low-income customers? No. They found other ways to remain profitable while treating customers fairly. The real issue is that banks have built their retail banking operations around FEE revenue from financially stressed customers. A study in 2021 found that low to moderate income households spent $127 billion annually on interest and fees for basic financial services. These families spend 7% of their income on banking fees, compared to just 3% for wealthier households. Think about that for a moment. The people with the least money pay the highest percentage of their income for basic banking services. Meanwhile, customers with substantial savings often get these same services for free. It is a reverse Robin Hood system that takes from the poor and gives to the rich. The $100 threshold research reveals something fascinating. Even having just $100 in savings dramatically improves financial satisfaction and decision-making. People with savings balances over this tiny amount report significantly better financial well-being, even when controlling for income, age, education, and family status. It is not about the amount, it is about the psychological buffer that savings provide. Financial stress literally rewires your brain. When you are constantly worried about money, you experience what researchers call cognitive scarcity. Your mental bandwidth gets consumed by financial anxiety, leaving less capacity for productive work, good decisions, and long-term planning. Workers without emergency savings are 4 times more likely to be distracted at work due to financial stress. The research shows that 51% of investors with no emergency savings reported increased financial stress year over year, compared to only 15% of those with at least $2,000 saved. Having that financial cushion does not just improve your bank balance, it improves your cognitive function, work performance, and overall life satisfaction. Banks understand this psychology perfectly. They have designed their fee structures to keep customers trapped in cycles of financial stress. Overdraft fees often trigger more overdraft fees. A single unexpected expense can cascade into weeks of banking penalties for someone living paycheck to paycheck. Meanwhile, credit card debt has reached record levels. Americans now owe $1.277 trillion on their cards, with the average indebted household carrying nearly $8,000 in balances. Credit card companies are charging over 20% interest on average. 61% of cardholders have been carrying debt for over a year. For many people, credit cards have become an expensive form of emergency savings. The current savings landscape is brutal. The personal savings rate has fallen below 5%, dramatically lower than the 32% peak during the pandemic. Most Americans burned through their pandemic savings and never rebuilt their emergency funds. Only 46% have enough savings to cover 3 months of expenses. Yet high-yield savings accounts are offering nearly 5% returns, the best rates in over a decade. $20,000 in a quality savings account can earn $870 per year in interest. That's meaningful money, but only if you can accumulate that initial nest egg. The path from financial stress to financial security is not linear. It requires breaking free from fee-based banking relationships, eliminating high-interest debt, and building that crucial emergency buffer. Every dollar saved reduces your vulnerability to the predatory aspects of the financial system. Banks profit from uncertainty and desperation. When you are scrambling to cover rent or worried about bouncing a check, you will pay whatever fees they charge. You will accept terrible interest rates on emergency loans. You will use expensive services like check cashing or payday lending because you do not qualify for better options. At $20,000 in savings, this dynamic reverses completely. You become the customer banks want to attract rather than exploit. You qualify for relationship bonuses, fee waivers, and premium services. Your improved credit profile opens doors to better loan terms and investment opportunities. The banking industry's resistance to overdraft fee reform reveals their true priorities. They claim to serve underbanked populations, but their business model depends on keeping these customers financially stressed. Real financial inclusion would mean helping people build savings and avoid predatory fees, not maximizing revenue from their desperation. The psychological research is clear. Emergency savings buy peace of mind and provide a buffer when things go wrong. Having $20,000 saved does not just protect you from financial emergencies, it protects you from making expensive decisions driven by fear and scarcity. Your bank wants you living paycheck to paycheck, making minimum payments, and paying fees for basic services. They have built their profit margins around your financial vulnerability. When you accumulate substantial savings, you break free from this extractive relationship and start using the financial system to build wealth instead of just surviving it. The path to $20,000 in savings is not easy in an economy where basic expenses consume most people's income. But understanding how the system works and how banks profit from your financial stress makes the goal clearer. Every dollar saved is a dollar of independence from a system designed to keep you trapped. The question is not whether you can afford to save $20,000. The question is whether you can afford not to. Your financial future, your mental health, and your relationship with money all depend on crossing this crucial threshold. Your bank may hate losing a profitable fee-generating customer, but your future self will thank you for making the leap.